Okay, here we go. So now let's look at actual accounting transactions, okay? So a transaction is an event that affects the financial position of the business. It can be measured reliably. Many events affect a company, such as selling merchandise to a customer, getting cash in return, purchasing a vehicle, signing a loan. In accounting, every transaction impacts two items. Remember, I used the term double entry. That's because every transaction impacts two items. And that's also how we maintain our accounting equation. So let's look at some examples. Okay, an event that affects the financial position, recorded reliably. Every transaction impacts at least two items. The accounting equation balances before and after each transaction. Here's some examples. Okay, so what we've got here is this. Here's my assets. I've got cash, 2,500, accounts receivable, 1,500, no supplies, and land of 1,300. So that's $17,000 that I have in assets. Okay. Now my liabilities, or starting with payables, I owe $4,000. And in capital, there's $13,000. So there's our equal. Assets are 17,000. Liabilities plus owner's equity is 17,000. And yes, I know the name Maryland Mansion really looks funny. I get it. So that is our accounting equation. That's what's on our books currently. So that demonstrates how the transaction works. Now, the first transaction, what ends up happening is the owner invested cash. So the owner put $10,000 worth of their own money into the assets. Okay. Now, when they put their own money into the assets, it's not revenue, it's considered capital. Okay. So we received cash of $10,000, and there it is. And then we also added 10,000 to their capital. Okay. So $10,000 cash went into our cash account. 10,000 is considered capital now. So we've just added 10,000 to both sides of the equation. Now my equation, assets equal 27,000. Here's the new balance for cash. And our liabilities plus owner's equity equals 27,000. Here's the new balance for capital. Okay. Now, in transaction B, the business performed services and received cash. Performed services, that's going to be a key phrase for earning revenue. So what that's going to do is it's going to increase cash by $1,100 because that's how much they paid us for the services that were rendered. And $1,100 goes into the capital account. Remember, a few slides ago, we talked about what goes into capital, and one of those items is revenue. So for simplicity, we're just going to add it straight into capital, okay? So now I've added 1,100 to both sides. So now I've got my assets equal 28,100. My liabilities plus owner's equity equals 28,100. So here's my new cash balance. Here's my new capital balance. Now in transaction C, the company paid off the accounts payable. Both cash and liabilities are decreased by $4,000. So I had liability of $4,000. Here's my accounts payable. This was money that I owed. And on this date, I paid it. Well, if I'm paying, that means I'm decreasing my cash. That's what I gave him. So two things are going to be decreased. I no longer owe $4,000. So we're going to subtract $4,000 from my accounts payable. And I took $4,000 out of cash to pay him. So I'm going to subtract $4,000 from my cash, which was $13,600. Now notice that both of these numbers are in parentheses. When you see a number in parentheses, it means minus. So instead of having a minus sign, whenever you're subtracting a number, just put it in parentheses. So 13,600 minus 4,000. My new cash balance is 9,600. My accounts payable, I owed 4,000. I paid it. So now I subtract 4,000. My balance is now 0. So now if I add up all my assets, it's 24,100. And then a liability plus capital, also 24,100 because there's 0 there. Okay. So my accounting equation still balances. In transaction D, the company purchased supplies on account. I've got to have supplies. I need pens, paper, anything that I use that is kind of a disposable. These things get used up. Could be something as simple as staples, paper clips, whatever. But my supplies could be forms that I use. All of this stuff was depleted. I had to buy more. And instead of using cash, I bought them on credit. Okay. So I gave them a credit card or whatever, and they gave me my supplies. So the term on account means that I'm going to pay later. I've just created a liability. I owe. Okay. So let's look at our accounts. What did I do? Well, I added to supplies by $700. That's how much I purchased, was $700 worth of supplies. So I'm going to add 700 to supplies, but I created a debt, a liability of $700. So it goes into a payable account because I have to pay it. So that now has a balance of 700. Remember, before it had 4,000. I paid it. Now I've added 700 more to it that I owe. So here's our accounting equation. Cash plus accounts receivable plus supplies plus land equals 24,800. Accounts payable is now 700 plus 24,100, 24,800, it balances. And the term you'll hear a lot is, do your books balance? And when they say that, what they mean is, do your assets equal your liabilities plus your owner's equity? And there's the equation, okay? That's what they mean by do your books balance. And yes, they do. Transaction E, the company collected cash from a customer on account. In this case, on account refers to the accounts receivable because they paid us. Okay, so when somebody owes us money, it's a receivable because we are going to receive it. And customers will come in and they will pay us and give us cash. So now this time, again, 2 items were affected, but they're on the same side of the equation. So I've got a plus of $600 in cash and a minus in $600 because they paid part of what they owed me. So they don't owe me $1,500 anymore. They only owe me $900 now. So I subtract it. So on the same side of the equation, if I add 600 and I subtract 600, it still equals. Okay, it's basically a wash. So my assets are 24,800 still. My capital is 24,800. So my books still balance, but I still affected 2 different accounts. Transaction F, the company received cash from its owner. This is very similar to transaction A. In other words, they invested another sum of money into their business, directly into their business. It's not income, it's not revenue, because we didn't earn it through the day-to-day business. Instead, the owner just put the money in. So it's just like A. We're going to add cash of 1,700, and these numbers are arbitrary. It's just what the owner decided to put in. So they put 1,700 in. So we add 1,700 in cash. On the other side of the equal sign, we add 1,700 to capital. Now our new balance is 26,500. Assets, 26,500, liabilities and equities. A lot of times students will ask me, well, where did that number come from? And in this case, it's just arbitrary, okay? For just illustration purposes, this is how much she put in. In the other one, that's how much supplies we bought. These numbers don't come from anywhere in particular. Transaction G, the company performed consulting services. So now we have more services. It's not inventory, it's not merchandise, we're providing a service. Since they provided these services, we earn revenue. Okay, this is income. This is what our business is. It increases capital, but cash wasn't received. The company billed the client. So we performed these services, but didn't get anything in return. So that means that they owe us. Okay. So in this case, because they owe us, that's going to turn into a receivable. They owe us. We're eventually going to receive money from them. So we're going to add to our accounts receivable by $4,300. That's how much it was worth. And we'll add to capital $4,300. Now, here's the interesting thing, okay? Even though we haven't received the actual cash, we still have to recognize it as revenue. Revenue has to be recognized in the period of which it is earned. We earned it when we gave the service out. So at that point in time, we have to recognize the revenue. That is an major accounting principle right there. Expenses and revenue have to be recognized in the period that they've been earned. So even though I didn't receive cash, I'm still going to recognize it as revenue and add to capital. Okay, so 4,300 in accounts receivable was added, 4,300 in capital was added because it's revenue. Something else to note here, when it comes to accounts receivable and accounts payable, we're kind of, and again, it's for simplicity, we're kind of using lump sums, okay? But in reality, every single person who owes you money will have a separate account receivable just for them, so that you can keep track of their individual record as far as payments and adds and subtracts. Same thing with accounts payable. Every creditor that you owe money to will have a separate account payable in their name, so that you can keep track and monitor how much money you pay, how much money you add to that, so on and so forth. So for our purposes in illustrating here, it's just kind of lump sums, okay? As we go on further in our studies, we'll be more and more detailed. In transaction H, the company pays two expenses, rent and advertising. Expenses are going to decrease capital. Remember, capital is your net income minus withdrawals. Net income is revenue minus expenses. So expenses will always decrease the value of our capital. So in this case, we spent $1,000 between rent and advertising. So where is that going to come from? Well, first of all, I had to pay cash. Okay, I had to pay for these things. So $1,000 comes out of my cash account. So 11,900 minus 1,000 for I assume rent, and then 300 for advertising. So these have to be subtracted from cash. My new balance is 10,600 for the cash account. Now I also have to subtract them from capital because they were expenses. So $1,000 rent expense, $300 advertising expense. Okay, so I've subtracted 1,300 from both sides. So my accounting equation should be equal. Assets are now 29,500. Liabilities and equity are 29,500. So we're good. Transaction I, the company returned supplies and received cash back. One asset increases cash, one decreases supplies. So we're on the same side of the equation again, except we're going to have a plus and a minus. So that's going to be a wash. So my accounting equation will stay the same. Now, for whatever reason, I decided to return $100 worth of supplies. Maybe I didn't need that much. Maybe whatever I purchased had errors. Maybe I bought some forms, and when I went and looked at the forms, there were some misprints on it. So I returned them. So what that meant was I decreased the amount of supplies I had by $100 from 700 minus 100. Now I only have 600. And cash, I just added 100 because they gave me $100 refund. So on the same side of the equation, I had a plus and a minus for the same amount. So it's a wash. My assets still equal my liabilities and my owner's equity. Now in J, the owner decided to take a vacation, so they withdrew $2,200. Withdrawals are contributions to owners, and it decreases capital. By taking out $2,200, that also decreased my cash, okay? It physically came from the cash account, but it also had to come out of the capital account. So we're going to see a minus for 2,200 and a minus from capital for the same amount, 2,200. So now assets are 27,300. Liabilities plus owner's equity is 27,300. So everything matches. So we've gone through all of these transactions, and now we're at the end of our accounting cycle, like the end of our accounting period. Okay. Usually we do all these things at least on a monthly basis, or at least a quarterly basis. You don't wait a whole year to do this stuff, because if there's any problems or issues, now you've got to go back 12 months and try to find it, which is next to impossible. Whereas if you're doing things, closing the books every month, you've only got to go back 4 weeks if there is any kind of an error, and try to find your mistake or try to find where things are wrong. It's also a lot easier to compile information if it's only been 4 weeks. So now it's time to do our financial statements. There's 4 financial statements that are of value to us. The first one is the income statement. The income statement basically is just that. It tells us what our income was. What did we make? We're going to have goals, and one of the goals is going to be income. And how do I know on a month-to-month basis if I'm hitting my goals? The income statement. The second one is the balance sheet. The balance sheet is going to list all my accounts, and it's going to be based on the accounting equation. When I do the balance sheet, assets have to equal liabilities plus owner's equity. Another statement that I need is the statement of owner's equity, because the owners want to know where they stand in the business. What's my stake in this business? Well, the statement of owner's equity is going to take all of the revenue and expenses. It's going to zero that. It's going to compare them. Plus, it's going to subtract the withdrawals, and it's basically going to show all activity that occurred with their owner's equity throughout that period of time. And then the statement of cash flows, what that does is that basically tells me where my cash came from and where it went. So I'm going to start out with on the first of the month with a cash balance, and on the end of the month, I'm going to end up with a different cash balance. The statement of cash flows is going to explain how I got from the beginning balance to the ending balance. This is where it came from. This is where it went. That can be a real eye-opener, because you might be thinking, oh, look at that. Gee, I'm increased cash by $20,000. Then when you look at it in a more detailed view, you realize it should have been $50,000. What was this cash outlay for? What was this one for? I've made some bad management decisions, or my manager has. So the statement of cash flows is going to give me that information. Now, one important thing to remember is that these statements have to be done in order, because the information found on one statement is used in the next statement. So if you do them out of order, you're not going to have up-to-date information. Here's the example. The income statement is done first. We take all of our revenues and we list all of those, and then we total them. Then we list all of our expenses and we total those. And then we subtract expenses from revenues, and that will give us our net income. That's basically what the statement tells us, okay? We need net income to determine what the owner's equity is. We can't determine it if we don't know what net income is. So in the owner's equity, we're going to take the beginning balance. We're going to add whatever the net income was. Now, it could be a negative. If there was a loss, then instead of adding, we could be subtracting. It depends. Hopefully, it's a net income. It's a plus. From that, we're going to subtract the withdrawals. Remember, he took out $2,200. Okay. So net income minus the withdrawals gives us our ending capital balance. So we've got the beginning balance plus or minus any changes equals our ending balance. Now you're going to see that particular format a lot in this in accounting, where you have a starting balance plus or minus any changes equals your ending balance. Okay, that's the format of the statement of owner's equity. Now we know what their ending capital amount is. That information is necessary on the balance sheet. The balance sheet is going to list all of the assets, and then it's going to give a total. Then it's going to list all of the liabilities. Then it's going to give a total. Then it's going to list all of the owner's equity account. That balance is going to be there. And then you're going to see that you're going to have assets. There's one number. And then you're going to see liabilities added to equity. There's your second number. Those two numbers have to equal, because there's our accounting equation again. Assets equal liabilities plus owner's equity. So I took the net income from the income statement. I brought it over to the owner's equity statement. I calculated the new owner's equity, and then I plugged that into the balance sheet. If I don't do that, then my owner's equity is going to be wrong, and my balance sheet isn't going to balance. I'm going to have too much in assets, not enough in liabilities and equity, or vice versa. So that's why I have to do them in that order. So there's my balance sheet listing assets, liabilities, owner's equity, and showing them as an equation. And then finally, the statement of cash flows. Again, it's going to start off with the beginning balance of cash. And then we're going to have pluses and minuses. And after all the pluses and minuses, you're going to come up with a final ending balance. That number should match the number in your actual cash account at the end of the period. Okay, so that's the statement of cash flows. We'll get into them more in depth later. So here's an example of an income statement, and I want you to notice the format, because formatting is important, because whoever is reading these statements has to understand them. It has to be very clear, very precise, and in a format that they can understand. You might be looking at a statement and say, well, I understand it. Well, of course you do. You did all the work. But somebody from outside who's looking at the final product, they might not. So we've got to do that. So as you can see here, they start off with revenue. Now, in this case, all we had was service revenue, okay? There might be 3, 4, 5 different types of revenue, okay? For simplicity, they just put down service revenue for now. But you could have merchandise, sales revenue. You can have all sorts of different revenue. They'll list them all here under revenues and then put the total. Now, if there's more than one, you'll have a column for subtotal. And if there's only one, then they'll bring it all the way to the total, okay? So in this case, expenses, we had 2. Rent expense of $1,000. Total advertising expense of 300. Total expenses 1,300. Net income is 4,100. So we took revenue 5,400, subtracted the total 1,300, came up with 4,100. So there's my net income. Now in this particular case, these were subtotals. We added them together to come up with the total. We subtracted, and that came up with, now technically you could have put 1,300 in parentheses. That still would have been correct. Okay. Okay, so here's the statement of owner's equity. Now, in the beginning of our example, we started off with 13,000. Over time, the owner put in 11,700. We added the net income from the prior statement, 4,100. So we're adding $28,800 to their equity. They took out 2,200 for whatever reason. So we have to subtract that. So here we go. Starting balance plus any investments by the owner plus net income minus withdrawals. My new balance is 26,600. So there's our statement of owner's equity. Now, this number is important because we need this accurate for the balance sheet. So here's our balance sheet. Now, on one side, we've got assets, cash, 8,500, and these are taken right from the actual accounts. Accounts receivable, 5,200. Supplies are now 600. Land, 13,000. Total assets, 27,300. Liabilities, accounts payable, 700. Owner's equity, 26,600, which we just calculated from the last statement. Total liabilities and owner's equity, 27,300. So they balance. Now, in this particular format, they've got assets on one side, liabilities, owner's equity on the other side. Makes it easy to see the accounting equation. In some cases, you'll see them top and bottom. So assets will be at the top, and then down here underneath, you'll have liabilities, and after that, owner's equity. Okay. Now, as far as the order of things, if you'll notice, cash was first, accounts receivable second, supplies, land, total assets. These things are in a specific order. The order of which things are added to the balance sheet is based on their liquidity. In other words, how fast can these be turned into cash? So cash, already being that, is first. Accounts receivable is going to be second, and so on down the line. As we start getting 10, 20, 30 different accounts under assets, we're going to list them as far as how quickly they can be turned to cash. Okay. Now we're going to talk about how we use these, okay? The relationship among financial statements. So the income statement, revenue minus expenses is net income. Net income is used to determine owner's equity. We add net income, subtract withdrawals, and then assets are on the balance sheet, liabilities plus owner's equity. So you can see there's a relationship there and why they have to be done in order. Income statement demonstrates profitability. Statement of owner's equity shows the changes in capital. And the balance sheet shows financial position. And that is the end of chapter 1. So that's some of the basic stuff, but it's also very important stuff. Please spend some time on this, learning this stuff. Start the practice. Now, the practice sheets that I've given you, they encompass all 4 chapters. So you're not going to be able to do it all. Just take a look at it for now and see basically what it is. And as we do chapter 2, 3, and 4, it'll all start to come together. Right now, it's not going to come together because there's stuff that you haven't had. But take a look at the practice for chapters 1 through 4, and you'll start to see some of this stuff. Don't worry about doing anything just yet because we haven't talked about it, okay? But this is chapter 1, some very important foundation work. So that's it. So I will talk to you on Thursday, and we'll go over some of this stuff. All righty? That's it. Have a good day.